All right, everyone. Thank you very much for joining us today. Today we're going to be doing a little bit different webinar from the ones that we normally do that focus solely on self-direction and self-directed type of investments, and do it a little bit more a theoretical and practical application of good and best practices in retirement planning, how to get started, what people need to kind of look at if you're just starting or if you're looking at getting a game plan today. We're going to cover 10 main points for you to take away today to really kind of get a good idea and good roadmap together for how you're going to start your comprehensive retirement plan. A little bit about myself. My name is Alex Perney. All of my contact information, my direct line and cell is right there up on the slide in front of you. I've been doing this for going into my 6th year now. I'm a member of the American Banking Association and a certified IRA services professional, and a member of the American Trust Banking Association as well. So although my basis of expertise lies within self-direction and non-traditional assets, I can answer any questions with regards to retirement plans and general concepts with regards to 401ks, small business plans, if you're in the armed forces or have a thrift savings, any type of retirement plan, even if it's a large pension, we can get questions answered about that, and also which ones make the most sense for you to start with as well. So there's a few key points that I really do want everyone to take away from here today. The first one is that there is no one plan that works for everyone. You have to really get down to what your ultimate goals are, what you're trying to accomplish, and the time frame you're trying to accomplish that in to really understand what's going to work best for you. And understand that even though you may have someone that is almost an exact replica of you with regards to age, needs, retirement goals, and the ultimate date of retirement, you may have different game plans that suit you best. Not everyone is going to be the same, so don't necessarily just look to your neighbor or someone similar to you, although it is a good place to start. Look at some of the key factors that we're going to point out today as a good starting point for how to do something that works best for you, because everyone inherently is an individual and everyone needs to have an individual game plan. Like with any game plan or any game that you play, especially sports, you need to have a network of people. You need to have a team around you that really helps drive you towards your goal and keeps you accountable to yourself and anyone else that's going to be relying on your retirement in order to help keep you on track for that. Everyone kind of falls off every once in a while. No one's perfect. So in order to make sure that you get to where you want to go and attain that plan that you have set out for yourself, get a support network. Build it with your spouse, with your children, with your financial advisors, with your attorneys, and we'll get into kind of some of the things that you can do to help implement those types of safety nets and accountability structures into your plan. But understand that having a network of people around you that can help keep you on the track of the plan that you have done is incredibly important. And education is key. You can't do any of this without a good foundation of understanding what you're doing, understanding where you want to go, and understanding what it's going to take to get there. So make sure that with all of this, with anything that you're doing with your planning for retirement, that you understand what you're doing and you understand how to get there. And the way to do that is education. There's a lot of different kinds of education out there, and we'll cover the different types out there and what to look for. But remember, education is key. So the big points to take away: there's no one plan that works for everyone. You need a network, and make sure that you stay educated and up to date on what you're doing, because this marketplace changes. If you're going to be working into your 70s and you are 40 now, you have 30 years to make a plan. To give an idea, 30 years ago was 1988. You have the difference, or 1987, my apologies. You imagine the difference in the market and the investments and the game plans from the late 80s till now. It's huge. So just understand that if you are in your 40s now and you're just starting, your game plan might change incredibly. Just think about those two different times. With regards to legislation, with regards to our economy. So understand things change, so the education is absolutely paramount. Before we really get into the main topics, I want to let you know a little about who we are. We are a self-directed IRA administrator, meaning that we handle everything that big banks and brokerages don't necessarily have the capability to do or really the interest to do. Mainly based in real estate, private investments, private LLCs, different types of real estate investments. It's a very kind of interesting dynamic of what we handle. Pretty much everything that's not traded on the stock market is where we come into play in helping people take control and really get a hands-on approach to their retirement. So if that's certainly something that sounds attractive to you and you're a very hands-on person, the platform that we have can certainly be a great benefit to you and can be a good diversifying agent for any type of retirement plan as well. We have well over 20 years of industry experience here. We've been operating here in the Florida area and the Atlanta metro area in Buckhead since 2004. We have multiple depositories, so we maintain full FDIC coverage for all of our clients. Currently, we do maintain roughly a little bit south of $800 million under management for our clients. And we also have dedicated account representation. So if it's something that you're just getting started with, we do offer a concierge service to help our clients maintain and really achieve their goals, because you can roadmap your goals with a single person instead of trying to do it on your own or without someone there holding your hand with your retirement vessels that you're choosing to invest in. So we are located in Florida and Georgia. AdvantaIRA.com is a good place to find our new events, look at our offices, find our hours, and the things like that. We are open 8:30 to 5 Monday through Thursday and close at 5 or 4 on Fridays in both locations. So jumping into it, again, make sure that you type in any questions that you have. Everyone's muted, so the only way I'll be able to get to your actual questions are through the chat box. Please make sure that you fire them off throughout the thing. It does help to enhance any type of webinar to have the Q&A going, because if I just do what I do, maybe your one specific question might not get answered. So keep them coming. Don't be shy with the questions. The first point I want to bring up to people is don't avoid thinking about it. So many times people get wrapped up in the here and now with their personal lives, which is incredibly important. Nothing that we're going to cover today should be taken as an aside to your personal life. You have to make sure you put food on the table. You have to make sure you're taking care of your children and your other responsibilities in life. Your retirement is for the end of your working life, but it also is a very important part of that. And making sure that you can balance those two things is really kind of where some people kind of lose track about it. But don't avoid thinking about it. It's really easy to get caught up in the here and now, but understanding that you have a responsibility to the same people and maybe in a different capacity farther down the road is something that, some people might try to avoid thinking about. Obviously, the earlier that we can think about this, the better. The earlier you start retirement savings, the less you'll have to worry in the future. Also, the less you'll have to save in the future. If you start a basis of saving now, you're going to be saving for longer. You're going to be saving more money. So the actual burden to you in the future will obviously be less. Now, some of this may seem like common sense, but to have it enumerated in front of you and to really think about it in that aspect of, hey, if I start when I'm 20, how much less am I going to be saving when I'm 60? Well, if you use the present value of the cash saved over, let's say you only start saving when you're 40, you have 20 years of savings. Even if you're only saving, let's say $10,000 a year, and that's a very, very generous estimate for a 20-year-old to be putting away that much money. But just for a round number, then you're looking at roughly, let's say, $200,000 to $400,000 less of money, assuming growth in a standard model, that you're going to have saved over 20 years with a standard 401k or other type of growth vessels that have tax-deferred savings because you're getting deductions, and with the effect that there's relatively easy growth patterns to see in those. So don't avoid thinking about it, because the longer you do, the more it's going to hurt in the end once you get to the point where you actually do need to look at retirement. Now, the first step is the hardest. Let's take it from the point of view that someone has not started their retirement planning. Now, you may have a budget that you are inherently very accepting of, you're very used to. Now, how do you work in something if you're not putting away a ton in personal savings that's going to help maximize your retirement savings? Well, the easy answer is you're going to have to make some sacrifices. But the little bit more complicated answer doesn't have to be that painful. Reformulation of a budget isn't inherently cutting out everything that's fun in your life in order just to do what you'd like to in retirement. The key way that I point this out to people is that understanding, and this will tie into the support network that you have, Understanding the fact that some types of savings offer deductions. So if you are adding money into a 401k or into an IRA, the money that you're putting in there isn't necessarily just gone and you can't touch it. You're going to be capturing some of that back in the deductibility of that contribution. Yes, you will not have the ability to use that in the present, but understand that it's not necessarily money lost. So instead of just saying, okay, I'm going to take $200, out of my personal savings that I'm putting in every month and put it into an IRA, it's not necessarily the same, because instead of maybe, let's say, losing that 200, you might only be losing, let's say, 160, assuming you get a deduction of 20% of what you're putting in there. Understand that the deductibility of certain types of accounts could really help you in your plan. So the other way to go about this is that, you have these things that are going to be in front of you, and taking the first step and understanding where to put it is important, but what kind of tools can you use to get that going? Yes, everyone understands that they need to save. Everyone understands that retirement's important, but what kind of tools can you use? As corny as it may sound, and as much, let's say, textbook type things that college that they teach you in college that no one ever uses, are things like agendas and vision boards to actually put things in front of you and make it accessible visually as well as mentally to you for the actual goals that you're trying to achieve. If you can reinforce the ideas with yourself that you are going to be saving for retirement, and especially in the beginning when it's going to be something that you are rearranging your personal life around, having it in the ability to remind yourself as much as possible of your goals can really be effective. Now, it definitely might kind of fall in under the, let's easy example of the Tony Robbins type mentality of, utilizing something that, people might kind of laugh or say, oh, you know what, that sounds fun, but, it doesn't really work in practicality. This stuff does work. There's a reason that, this stuff is out there and it has been used for so long. Making it so that you have a visual reminder as well as a physical reminder in the people that are around you is going to be important for the long-term success of this. And also understand that with your first step of maintaining things like agendas and other things that can help you visually look at this, you don't have to start huge. This is a marathon, not a sprint. You are working towards a goal that is hopefully for most people is relatively far off. If you're starting this at 60, you are certainly, in all honesty, much farther behind than someone that's starting it at 40, 50, or in their 30s. So understand, if you're looking at this from a perspective of having a game plan for 30 years, yeah, the first step's the hardest. The older you get, the harder it gets, but you do have a lot of time for this. You're not saying, oh, I have a vacation I have to save for. You are saving for the end of your life. You are saving for that time when you are too old or have no more willingness to work. So understand that it may be hard in the beginning, but the payoff's going to be huge in the end. That kind of brings us into this, is understanding your timeline. You're going to have short-term goals, and you're going to have long-term goals as well. Now, short-term goals, I typically try to categorize into personal things. Most of the time with retirement, you're not looking at any sort of short-term goal. It's the short-term goals are really going to be maintained for your personal assets and personal responsibilities. So if you have children, if you have a house payment, if you have a car payment, whatever your recurring expenses are, things that you have, a liability to pay on a daily, monthly basis, categorize as those your short-term goals. Those are kind of the goals that you need to separate from your retirement goals, in that these timeline goals are short-term. These are your personal savings goals. So when you're redoing your budget and you're taking that first step, what can you cut out to make sure that you have a cushion as well as the ability to cover those expenses? And then taking that difference, and that's really that difference of the extra that you're putting in your savings, past your comfortability cushion and the covering of those responsibilities, and then looking at that as a long-term goal. So taking that net difference between the two and looking at it as a long-term plan. So understand that when you're looking at your goals, you're going to have different ones. Everyone has different goals in life, but they are going to generally be categorized into two different sections: short-term for personal things, long-term for retirement goals. Now, retirement goals need to be a little bit different. It's easy to say when I'm going to have my mortgage due each month, when I have to pay my insurance, my water bill, my power bill. when you have to pay all those things that you have a general monthly or personal responsibility for, it's easy to put an exact date on it. It's hard to put an exact date on retirement. So people typically look at this as a year or a date range. Now, understanding that, make sure that your retirement goal is realistic. Not everyone is probably going to have the goal or the ability to retire when they're 40 unless they have incredibly high paying jobs or got incredibly lucky. Things like that don't happen. So make sure that first that you have a very realistic goal. If you are 50, is it realistic? Are you making enough money right now to put enough away to where that you can retire at 60 or let's say 70, retire at 70 and then live till you're 85 or 90, have enough money for 20 or 15 years of not working, including medical bills, including cost of living, including discretionary income. So making sure that you have a realistic game plan for when you're looking to do that. And then also saying, hey, is this attainable? Realistically, am I going to be able to cover my short-term goals, my short-term commitments, and then have an attainable future? So the realistic, attainable goals are what we're looking at. It's always great to look at saying, hey, I'm going to retire and travel the world and buy property and do these kind of things. But, maybe look at it, scale that back a little bit. Have a very candid conversation with yourself and say, hey, what is attainable? What is realistic? How am I going to get there? These are the kind of things that are going to make this a doable goal for you, because if you set your sights way too high, you're never going to get there. But if you set them too low, the same is true for not being ambitious enough. So making sure that you balance the attainable and realism of your goals is incredibly important in this. And remember, even the best laid plans don't work if the goal can't be reached. So you can have a phenomenal plan, but if it's not realistic and it's not attainable, then it just looks really pretty on paper. It doesn't have any substance. So making sure that your goals and your timeline are in synergy together and they're working together and not against each other. Now, it's really kind of hard to look at this without saying, hey, what if I need this? What if I need that? The biggest thing that you can do is say, hey, my retirement savings, unless there is an act of God, are not to be touched. This is money that you need to look at when you put it in your retirement that you are never going to touch. I know a lot of people, and it's unfortunate out there, there are some people out there that kind of say, hey, you can take a bridge loan from your IRA, or you can take a participant loan from your 401k. It's ultimately up to a financial advisor to tell you if that's an advisable route for you to go, and everyone's different. But the real bad part about that is that whether or not it's a good idea for you is kind of irrelevant. It's the mindset that will put you into. If you start looking at the IRA and the 401k and the pensions as something that is to be used personally, then it kind of moves that money down a step in your mind of saying, hey, this is stuff I can use with right now. It's not solely for retirement. And then it can be kind of a slippery slope from there to, hey, this is retirement money. It's not to be touched. Oh, well, I'm just going to use it a little bit right here. Oh, well, let's file this in a little bit more, and let's not focus on my personal savings, because I have all this stuff right here that I can use every once in a while. And before you know it, you're behind the eight ball in a really bad position when it comes to retirement. So the biggest thing that I can stress from a general retirement savings point of view is that the more barrier you can put between yourself and your mind and your planning of retirement and your retirement savings of not using them until retirement, the generally better off you be. Now, how do you do that? There has to be a balance. This is your money. You need it for things. You have commitments. You have expenses. The money that is for what to come is not for the money, this money is not for what comes, not right now. I'm getting my own phrases mixed up. So understand that the retirement savings is for what's in the future, not right now. So your personal savings is what you have to look at for your general well-being and currently right now. So, take worst case scenarios. Take, let's say you have to buy a new car. You have to move. Up until a certain point, obviously, making sure that your personal savings is going to be able to cover that to the best extent of your ability so that you won't have to go into your retirement savings. So if that means putting a little bit away a little bit less in retirement, maybe that's something to look at. Understand that the ability to only have to use your personal savings and personal finances for what you currently need, and being able to completely separate in your mind the retirement savings from ever needing to be personally touched can be a very powerful tool. Because if you just kind of, in essence, forget about that money, that you have even the slightest ability to use it until you retire, can really help you to grow that money without any sort of disturbance from you taking money out, paying fees, paying penalties, paying taxes. That directly will affect your personal money, because if you have to take something out and pay a 20% penalty as well as income taxes, that's going to reduce the amount of money you have. You're essentially paying that to the government. You're paying that to someone else just to use something that is already yours, when if you could have had a better plan in the beginning, could have avoided having to pay sizable taxes and penalties to the federal government. So making sure that you maintain the balance can not only help you increase the amount of money you can have in retirement, but can help you decrease the amount of money you have to pay presently. If you're taking money out of a retirement plan, you might have to pay personal taxes on it. You might have to pay fees to the administrators. There's a ton of stuff that can go wrong with that. So making sure that your strategy involves a good dichotomy between the two and a good balance is incredibly important. So we talk a lot about, or we've talked about the personal and short-term goals. We've talked about, the fact that you should have the long-term goal and not touch the retirement funds. But, where can we see some ways to save money? Obviously, it's easy to say, hey, let's eat out less. Let's, not go to the movies as much. Let's take less vacations. There's a lot of big things that people look to say, hey, here's easy ways to save money. And indeed, those are all valid points. Those are all things that you need to look at. Is going out to eat 3 times a week more important now than being able to comfortably support yourself in retirement? It may not, your personal finances may not be that tight, or may not dictate that kind of concession needs to be made, but for a lot of people it would. So understanding that the present value of what you're doing, is it worth more to you now to do something that you experience, or is it worth more to you to have the security in retirement? And for the most part, a lot of the superfluous things that we do can kind of be cut out and removed when you kind of look at it objectively like that. Now, some things that are a little bit more specific to look at with how to save money regarding debt. A lot of people have debt of one kind or another. Now, we're not talking about institutional long-term low-interest debt. So nothing like, a first mortgage on your house that you're paying, let's say 3.5% is roughly what prime is right now. Even if it's a little bit higher, you're not paying much for that money. Housing expenses, typically the ability to pay that, either you're going to be paying rent or you're going to be paying a mortgage. You're building equity with a mortgage. So a lot of people kind of point to that as a slightly more attractive route. Ultimately, whatever makes the most sense for you is for a CPA or a financial advisor, but understand that things like long-term institutional debt's not really what we're talking about here. If you have debt that is high interest, let's just say over 6%. So if you have something like a lot of bills racked up on a credit card, you have private student loans that aren't capped by Congress for how much interest they can pay, pawn tickets, defaulted debt, medical bills, if you have payday loans, things like that. If you can avoid having things going on in your life that involve these, or if you can maybe consolidate some of these things into a lump sum lower interest rate payment, that might be a very easy way to, let's say not write a $20,000 check, but avoid paying, let's say, $8,000 in interest over 20 years. So the present value of the savings may not necessarily be appreciated, but the long-term savings, and again, remember, the retirement is a long-term goal, might be very valid for you. So depending on what kind of things that this chart represents for you individually, might very well help you on that goal of getting to retirement, and maybe even sooner, for the fact that you can save considerable amounts of money when you're not having to amortize that interest into your calculations. So with regard to that, the one thing I do want to point out, I put participant loans on there because if you do take a participant loan, and let's say you want to do an investment with a 401k, they do have the ability to take loans out of them. You are essentially, yes, you are going to be paying interest into your 401k, and some people might point to that as not be very valid to this chart. But what you need to look at is that, let's say you took $50,000 out of a 401k to do an investment as a loan. It's allowable. You're not paying taxes and penalties on it. Well, let's say you did really well on that loan and you paid it back on the investment and you made $100,000. So you pay back the 50 into the 401k, and then you have the $100,000 that you made outside of the IRA or outside of the 401k. Well, because essentially you didn't understand that there's other ways to structure this, you're going to be hit with short-term capital gains, 20%. You might be hit with a Medicare surcharge tax of 2.33%. So you might right off the bat lose 23% of your money. You might have to stroke a check to the federal government for $23,000. That's not attractive to anyone, certainly isn't to me. But understanding that if you do find yourself in a position where you have investments that are coming to you, and this kind of ties into the education portion of it, that you want to do that you're unsure of how to get those done in a qualified plan like an IRA or a 401k, give us a call. That's specifically what we deal with, is helping people that find deals or investments that aren't stocks and bonds. I would take it from the premise of this presentation that no one here is probably a registered investment advisor. No one here is probably a stockbroker. People here that are attending this webinar, and for no derision of the people that are here, don't have seats on the New York Stock Exchange. The majority of the investments that people are just kind of looking at are more traditional, but they may not understand them as well. But if you invest in real estate a lot, if you know a lot of people that do startups, and you can identify good private investments, you can do those within an IRA or a 401k, so long as you have someone that can hold it, and we can help you with that. So just understand that there are options out there for you. If you know of other investments that necessarily could really help you, and you get educated and you find something that you want to do, understand that it's all about the companies that you utilize to help you with it as well. That goes into your team, the team that you're building around you. So the people like your CPA, your spouse, your children, people that are keeping you accountable and people that are helping you out with attaining these goals, also goes into the people and who you choose to actually hold your money with can be a very big portion of that. It's a little bit of a tangent, but it is something that personally, besides my job, I do feel very passionate about. The fact that you do have choice. You're not just restricted to one type of investing. You can do whatever makes the most sense for you and whatever you understand the most. There's an option out there for you. So that ties in to this portion of it, which is being educated. Learn early and learn often. Make sure that you are hungry for knowledge and that you are absorbing what you are going to do. Now, it may not necessarily be easy for everyone to take a live webinar, but you can get on things like recorded webinars. You can read books. You can listen to podcasts. And in all honesty, when I try to explain some of this stuff to my wife, her eyes glaze over, and she's not the most interested person in some of these types of investment structures. But making sure that educate yourself to as much as you can handle. Not everyone wants to know everything about everything, but make sure that when you do your education, pick a amount of it that you can absorb. Make sure that you are taking in the form of it that works best for you. So if you like to listen to things while you're working on a computer, podcasts might be great for you. But if reading gives you a headache, picking up a book and reading a bunch of stuff may not be the best fit for you. So I encourage people to educate themselves with the platform that works best for them, with what really helps them best absorb things. And make sure whatever your preferred method is, that you continually do it. Remember, this is a long-term goal. You may get everything started, and let's say you spend 3 months out of 1 year getting everything started. You have your retirement plan set up. You meet with your CPA. You meet with your attorney. You get all these good pieces working. You get a good budget. You get your vision board. You really get a comprehensive plan together. But then after that, you stop educating yourself. Remember in the very beginning of this presentation, I mentioned 30 years ago was 1987. And it is night and day, the difference between our markets, our economy, our society, between those two times. Now, let's say in 1987, you just put some money in the bank for your retirement. Let's say you were 40 and now you are 70 and you're getting ready to retire. Do you think you would have done very well if you just set it and did not look at it at all between then and now and had no real basis on what's changing? If you were lucky, maybe. Let's say you bought a ton of Microsoft stock and you just let it sit there in the late 80s. You'd probably be doing very well. But I'd say the chances of that happening are microscopic to nearly impossible. So make sure that you educate yourself. At least once a quarter, get out there, take a seminar, find something that works for you, read a book, make sure that you're understanding that there is a dynamic to this, that the education is the base of this pyramid that we're building off of. And if we don't have good, relatively frequent education, you're setting yourself up to fail. And, that may sound a little bit harsh, but the reality of it is that the choices that you make and what you're putting yourself into and the investments that you're doing, they fluctuate, they change. So making sure that you educate yourself not only on the marketplace and the type of investments that you're doing, but what you're invested in will go incredibly far in making sure that you can achieve your goals. Because part of having realistic and attainable goals is making sure that the foundation that they are built on stays sound. So I can't stress enough, just make sure that you're doing it. It doesn't have to be something you do every week. I'm kind of the opposite. I'm kind of a glutton for learning. I'll do it every week. I'll do it every day if I can, but that's not for everyone. I know certainly people in my life don't like to do it that often, but just make sure you're doing it. Get out there. Like I said, learn early, learn often, and you're going to set yourself up for success. Because that way you might, maybe even if you're looking at the same topic multiple times, you might remember something, or it might kind of drive a point home that you then ask a question that will take you on another tangent of education that you may not have known and really help you out in the future. So understand that the education can drive the questions, which ultimately drive the knowledge that you're going to be getting for whatever's going to be helping you the most in the future. Now, a big thing about saving for retirement is, what pace should I go at? How should I pace myself with regards to how much money I'm putting away? Well, the easy answer is do something. Anything is better than nothing, and nothing will get you nowhere. At least something will get you on a path to retirement. It will at least get you thinking about it. Putting away $20 a week or $20 a month, $1 a day. You're doing something to where that you are actively saving for your retirement. You are making a conscious decision to go down a path that will ultimately get you to where you want to go. You can think all you want to about it. You can educate yourself all you want to about it. But if you don't make that initial first step, you don't actually write that check to your 401k administrator or your IRA administrator. Let's say you don't enroll in your company's 401k, or you don't write that check to your IRA administrator. You're never going to get any closer to having, real retirement savings than if you just didn't. So understand that starting it is the first step in the process. Now, what does that mean for everyone? Pace is going to be personal. It's not going to be something that is easily applied to every single person. I'm a 28-year-old. I can look at another person that is my same age, relatively same income bracket, and they may have a completely different lifestyle that dictates that they need to change something. If they have, let's say, 2 children and I have none, my ability to pace myself and save is going to be completely different than theirs. They're going to have different personal responsibilities. They're going to have different things that are going to factor into them being able to make a realistic and attainable retirement plan. For me, it may be very realistic for me to put away $300 a month into my retirement plans outside of my 401k. For them, if they have to pay for daycare, if they have to pay for different other things that go along with having children, after-school care, pre-K, things that are going to eat into their budget, maybe they only have the ability to put $50 a month into a retirement plan, such as an IRA or a Roth IRA. But that's still okay. They're still making that conscious decision to move forward, and that pace is what's going to make sure that this is a realistic and, remember, attainable goal for them. So now looking at pace, what goes into a pace? What is going to factor into it? Well, not just your personal liabilities and personal things that you're going to have to be responsible for, but also that the pace of your saving and the actual pace of the payout of the investments is going to drive some risk factors for you. So short-term gains are always typically going to be coupled with increased risk profile. So if you're someone that is trying to save at a fast pace later in retirement, well, that doesn't really necessarily go along with low risk investing. The higher the risk, the higher the reward. Everyone's pretty much heard that, and it absolutely holds true. Things that are highly speculative are going to be highly high earning, but they also have the high ability to take a huge nosedive. Case in point, earlier last week, there was some errors on the New York Stock Exchange that caused tech companies to get very spooked. You saw a large dip in the value of big key companies, things like Apple, Facebook, IBM, tech companies that have been doing incredibly well throughout the past 2 years almost, took huge losses. Now, yes, the actual investment in single companies and having a very narrow profile in a stock portfolio is going to be riskier. And let's say that you are someone that's late in life and you are trying to grow your portfolio quickly. Well, taking that hit and not having the ability to ride to another market uptick is going to be a very big issue for you. So remember that the pace not only refers to the amount of money and how much money you're putting in, but also refers to the style of investing that you're doing. If you're someone that is much younger and you can take those kind of hits, being invested in a little bit higher risk industries and maybe a little bit less diversification can yield higher returns, and you can absorb losses better, and your ability to pace and change the amount of money that you are saving is probably going to be a lot easier as well. So understand that the age that you are, the personal responsibilities that you have are all going to determine the actual pace at which you are saving and the pace at which you are trying to realize returns in your IRA. If you can afford to take it slow, you can typically avoid some riskier investments. So let's say you don't necessarily want to be inherently exposed to a lot of risk. Well, if you don't have to, and remember, this is money that you are setting aside that you are not touching, the huge gains may not necessarily be something that you need. If you're starting to invest, let's say at 20 in an IRA, you might have 50 years to save for retirement. Now, across that time, do you think you need to take high-paying, risky investments to really make a large, sizable retirement for you to have when you decide to stop working? No, absolutely not. You have a half a century to save money, and even at, let's say 4% to 6% returns, which are, very nominal with regards to the average, 30-year projected earnings of the domestic stock market, you have the ability to really make some huge profits and not necessarily have to take much of a high risk profile. So remember, a lot of the determination on the pace at which you are saving and the amount of risk that you are going to be pacing yourself with in retirement can be factored into a lot too of how much time you have until you think you're going to retire. Now, I just use arbitrary numbers like 20 and 70, but let's say you're somewhere where you retire later. You're not planning on retiring until you're 80. Factor that in. Don't use the common ages as something that you have to abide by. Remember, age is a number. If you feel great, certainly work as long as you want to, and don't touch your retirement until you need to. But just understand, again, this is all personal preference. If you work late and you have the ability to do so, put off retirement for a while. Don't touch the money longer and watch it grow and pay less taxes. So, it's certainly something to look at. And then your overall strategy is going to determine your pace. Income versus appreciation. Do you want to have something that is paying income to your IRA, or do you want to see something, or your retirement plan, do you want to have assets that are paying monthly income and cash flow? Or do you want to have something that is maybe not paying as much cash flow but is appreciating in value? Which one's more important to you? Now, it's going to change for a number of different reasons, but understand that there are different types of assets out there that will offer you different payment profiles that are going to directly, help you get to that attainable and realistic goal. So there's something out there for everyone. One glove does not fit all. Your pace is inherently very personal, and it's something that you can certainly figure out a little bit better by meeting with an investment advisor, meeting with your CPA or someone like that. They're the ones that can, essentially really help you make the best decision for what pace you need to start saving at and what pace you need to start putting your investments in as far as the appreciation or the cash flow that they're going to be making. So there are many ways to save. Everyone has a different place to capture money in their life. Now, we kind of went over the ways to get rid of debt. Debt's a big one. People pay a ton of money in interest every year to things that they maybe necessarily don't have to, and we did touch on those. So one thing that I like to say as far as, how do you save money with other things? Well, we touched on the incidentals, going out to eat less, things like that. And I don't need to cover those because those are really easy to identify. But how about something like paying for education? Well, most education you can get for free, just like this seminar. And all of our education that we put out at Advanta is always going to be free. Our goal in the market is to educate people on how to diversify their retirement with things that aren't necessarily, readily available on open markets like stocks and bonds. We want to show people that you have alternatives to take control with. So we put our education out there for free. You don't need to go out and pay $30,000 for a national seminar speaker to learn the inherent tips, tricks of whatever business and whatever investment profile that you're looking at. There are regular meetings that you can go to that are free, that they hold monthly, weekly basis that you can talk to people that have done, investing for many, many years, that you can get very sage and sound advice for no more than it costs you to drive to where they are. And with how cheap gas now is, you have less and less of an excuse not to make the push to get out there and learn from people that are doing this. I can't stress enough how much I have personally learned in the course of my professional career just by doing a lot of those things, by going out and being a part of Advanta at different investor meetings and things like that, and getting to actually meet people that have done investing and have saved for their retirement for 50 years. People that started when they were 20 or 18, with a goal of supporting themselves without having to work, or being able to, retire at a certain age, and getting their insight and how they have transitioned from decade to decade has been incredibly valuable to me. So understanding that there is tons of education out there, and I can't stress enough the need to do it for yourself. And you don't necessarily have to pay for it. Just because something has a high price tag does not mean it has a high value. Price and value to you are inherently two completely different things. Now, not to say if you have the ability to pay $30,000 for some type of, and they're out there, I'm not going to necessarily name names of high price things, but there are circuits out there, there are people out there that charge sums like that. But just because you can do it doesn't necessarily mean you're going to get that kind of value out of it. I've seen people that have done it and have thought it's a waste of money. I've seen people that did it and they were like, you know what, it got me thinking, it got me started, and it got me on the path to where I need to be. Whatever you think is going to get you on that path and get you started with that first step is inherently valuable to you in whatever amount that you think is going to be valuable in retirement. So if it's going to get you started and it's going to get you retiring 3 years earlier, then that $30,000 certainly seems like a valuable investment. If you don't think you're going to get any type of value out of it, going to free stuff is definitely more the route you can take. Now, certain types of investments are going to have inherent fees with them, and understanding that is going to really be able to help you to look at your goal, and depending on how old you are and what pace you're working at, really kind of tailor it to making sure that you are not necessarily paying undue fees for what you're doing. Things like different mutual funds and different types of aggregated funds on the stock market, hedge funds, mutual funds, things like that, might have what's called a load, or essentially a pay-to-play fee structure where you actually have to pay a fee to be invested with them. And then they also take a percentage of earnings out of that as well. So typically those funds, the reason that they price them like that or to say, hey, we have historically high gains, and this is what you're paying to participate in that. Is that a valid option for you? I'm not the one to say, but understanding that if you are going to be invested in something that has high fees, you might be able to maintain you might be able to attain the same type of gains that you would with a different type of investment structure, maybe something like real estate or a private investment in a local company. You might be able to get those type of gains on your money depending on what type of administrator you have that will allow you to do what you'd like without having to pay those kind of fees. So understand that just because something has an attractive profile to it doesn't necessarily mean that you're going to just be getting all of your money back. There are investments that have fees. Some are higher than others. Some are lower than others. So understanding what to look for. I would always ask, in the course of your education, especially with your CPA or investment advisor, ask about fees. Make sure you understand that, just like anything, your retirement administrators, are working to support themselves as well. And then there are going to be fees, and you're going to have to pay to do this. But understanding that, you shouldn't be paying more than you have to, and you shouldn't be paying for things that you are not getting a benefit from. So making sure that you're not paying too much for what you're investing in, very key to this. Obviously, adjusting your personal spending habits is huge. So like we've covered, cutting out going out to dinner, cutting out a lot of different things can really help you get more personal cash in there, but that's more kind of on the short-term side, which essentially will affect how much you can put into retirement. But that's kind of the easy low-hanging fruit. Consolidating high-interest debt into singular payments. People have probably seen it on TV, or different banks offer products where you can get, instead of having 3 different student loans and a credit card, they will issue you a loan at a, aggregated lower interest rate that you will be able to make one payment to and avoid, the higher interest charges on that and have money savings down the road. So things like that, if you have a lot of outstanding high interest debt, can certainly be a viable option for you. Again, getting with a CPA or an investment advisor to see if that is a good roadmap for you is ultimately the way to make that, unless you, again, educate yourself enough to know that that is a good or a bad decision for you. Contributing to tax-deferred plans. So when I say a tax-deferred plan, I'm talking about a traditional IRA, I'm talking about SEP IRAs, traditional 401ks, simple IRAs. Or any type of pension that you have, if you're an armed services, thrift savings, things like that. Any type of retirement plan that you add money into and get a deduction for will inherently help you save money as well. So you add in $100, but you get, essentially, let's say 20% of it back on your taxes as a deduction. That essentially is the net cost that it cost you to put $100 in was $80. So you can save money and recapture some of these things with effective tax planning. Now, effective tax planning is huge, and I don't really go into it too much in this because when I start talking about tax planning, people tend to get kind of scared and run away and don't want to talk about it. But it is something that is inherently very important. I can't stress it enough from the perspective that I have as an investment professional in this industry, how much money can be saved by the investor for their retirement plans and themselves personally by the effective use of different types of tax qualified plans. So all of your IRAs, your 401ks, and your pensions, they have a strategy that goes along with them, and the deductions that they offer to you can be hugely beneficial if you need them. So understand that what type of plan you are adding money into can be a huge benefit to you in the short and long term of your retirement goals in order to make those attainable and realistic goals happen for you. And again, making sure that you're filing your taxes correctly. CPA can help you with this so that you have the most deductions that you are taking advantage of is enormously beneficial to anyone. So how do you make all this happen? So we've talked about starting, we've talked about pace, we've talked about how to save money, find it, all these different kinds of things. But essentially, if you don't have anything to hold yourself accountable to, you spend that first 3 months doing all this and you leave it. And again, remember the example of 1987 to now, and you're not holding yourself responsible or looking at it. Well, what's going to happen? Well, probably nothing very good. So make sure that you have a system to hold yourself accountable, whether that's something that you have set up with your CPA on an annual basis to have a meeting to sit down and look at your finances and make sure that you are doing the plan that you set out to, whether that's more on the short term with your spouse, or your roommate or or your buddy at church, whoever it may be, to say, hey, have someone ask you the question, hey, did you do this? Or it's like, hey, what's this look like? And make sure that it's actually happening. Not everyone needs to have that kind of supervision on it. Whatever works best for you, but make sure that you have a secondary set of eyes on you and on this plan to make sure that it happens. Typically, the best people to do that, are the people that are going to be benefiting from this. So, I see between the two of you to say, hey, let's hold our household accountable for making sure that our goals are met. Every household's different. It doesn't always work like that. I personally understand that 100%. But the general idea is conveyed that the more accountability that you can input into your plan, the better off it's probably going to be. Because if you can have accountability for your plans and actions over a course of 30 years, how much more effective do you really think that that's going to be? Just personally, I think it's huge. The amount of success that you can have if you personally and externally hold yourself accountable for the plan that you laid out will just inherently make everything run a lot smoother. So, use people that are close to you. I put up, mailman, children, whoever you can do that is responsible and, that you can deal with regularly, make sure that they know and that they can help you with this and that they can be on the same roadmap too. Be that accountability partner for them as well. Make it a two-way street for both of you. And these people can change over time. Don't necessarily think that, the accountability aspect of your retirement planning has to be the same person. If it needs to change, make it change. If your CPA retires, maybe change over to your spouse. If your spouse is starting to yell at you too much about, talking about finances all the time, then you get the idea. Make sure that whoever it is going to be able to do it for you, and that you can do it for them. And ultimately, a good idea is make sure they have the same kind of values that you do. Not necessarily saying anything as, concrete as, morals per se, but probably a good idea on that front. Values as in, what's important. Is the short term or the long term important to them? Is retirement planning something that they are also doing? Values insofar as that they are on the same kind of path that you are will essentially help you get to where you're going probably a lot better if those kind of check boxes are marked. And then with professional partners, if you are investing with someone, they are a great person to have, accountability with. Make sure that y'all are on the same page with the investments that you're doing and how you are actually structuring deals and making sure that you're keeping each other accountable for how things are being done with regards to your personal and retirement investments. The people that you pay, make sure if you are paying a CPA or you have an attorney or a registered investment advisor, that you really feel like you're getting value out of them, that they are doing a service, that they are helping you stay accountable and on the right track. It is absolutely okay to change CPAs or attorneys. Ultimately it comes down to your retirement. Is the cost and pain of changing a professional advisor like that worth being able to retire 5, 6, 7 years earlier? I would inherently say yes almost every single time. So understand, if you don't feel like you're getting the most out of it, shop around. Make sure you have a good fit with your professional partners, that they are looking out for your best interest, your plan, and are helping you attain your goals. And the last thing I can say, communication is key. On this point, communication is key for accountability. If the people that are supposed to be holding you accountable and helping you be accountable for the goals that you set aren't being communicated with properly, how are they supposed to help you? They are never going to be able to essentially help you help yourself unless you have effectively communicated with them what the expectations are, what you're trying to do, what kind of schedule you're looking at. So just like with everything in life, proper communication with your retirement, with these types of plans will go very, very far in helping you actually get to where you're trying to go. And again, I know I do harp on this when I talk about the first steps and kind of the upper echelon of getting started with this, but education is key to this. If you don't understand what you're doing, you're not going to be able to see if something is starting to go wrong until maybe it's too late to change it or fix it, until you've lost money or you are not doing something that's in the best interest of your retirement for your specific type of plan. So when should you do education? do it as often as you can absorb it. If you are, if you're a sponge that can absorb a ton, do as much of it as you can stomach, as often as you can, because the more education you get, the better you're going to stay on market trends, the better you're going to stay up with things that are happening in legislation and things that are happening in our economy. So the more in tune and essentially the finger on the pulse that you will be if you educate often. If you can't do that, just make sure you're doing it as often as you can, because even if you don't do it more than, let's say, once a quarter, at least you're staying on top of it. And going to a course or listening to a webinar or podcast will at least get you thinking about your retirement and help keep you accountable for everything that you have planned out and spent time, money, and effort trying to achieve. Where do you do education? Education in our current society and our current world is global. You can get education from investment advisors in everywhere from Israel to China to Australia on your computer right now over lunch, and probably not pay a dime for it past what you're paying for your internet connection or the latte at Starbucks if you're doing it. So understand that the where, it doesn't necessarily have much of a bearing anymore, because with the ability to use technology, by the fact that every single person here is using technology to listen to me, means that you can get the best education for yourself almost anywhere that you go. And even if you do have to pay for it, almost all of those types of services and people that are providing that have the ability to be mobile. So if you're someone that's very mobile, understand that your schedule doesn't dictate as much of how much education you can do, excuse me, and how much education you can be a part of just by where you are. You can do this in airports. You can do it, riding to work in the morning, working out, anywhere you are, make sure that you can say, hey, I have some free time, let's do some education, or let's finish that podcast, getting through, what you need to in order to make sure that you are making the best plans and best decisions for your retirement is hugely important. And why? Understand that when you're looking at a piece of education and who's doing it, what's their ultimate goal? So you have several different categories of education out there. You have just the people that enjoy doing education. So maybe a person on a financial advisory show, someone from Fox Finance or MSNBC Finance or whatever news outlet that has a podcast or something. That's fairly highbrow. They're not really trying to sell you anything. They're just out there, promoting their own brand and educating the public. For what it is, better or worse, there is some good stuff to be gleaned from that. One thing I would caution people on is getting education from investment providers. Now, there's a difference between investment providers and service providers. A company like myself, we are a service provider. We provide a platform for people to choose their own investments and use our service to invest and do things as they see fit. We sell no financial products. You don't actually buy a investment from Advanta. You just use our service in order to make your goals happen. So getting education from a service provider that's not selling you any financial products, you're probably going to get a little bit cleaner information, if you will, from someone that's in our capacity, because we have really no interest in what type of investing you're doing. Ultimately, at the end of the day, if you use our service, it is just for the use of our service, not necessarily you don't pay a commission to us for how much money you made. It's simply just a flat fee that we charge for the service that we provide. Now, the reason I like to distinct that is that we do education on a ton of different topics because our clients like to do myriads of different things. They have a diverse backgrounds, as you can imagine. But when you get into education from people that actually are selling financial products, that are selling investments, that's where you do kind of need to be careful, because you need to make sure that they are not just trying to serve their own self-interest in the education that they're doing. So those types of educators that are inherently, let's say, educating you on insurance, but they're also an insurance agent, and they'll write you that policy they just educated you on. Did they leave out all the bad aspects of what they are doing? You have to understand that if people are inherently selling the financial product that you are going to be potentially buying, they may be coloring it in such a way that you don't see the full picture. So just making sure that you understand the background of the person that you are getting the education from and where their ultimate driving forces in life are, is really going to help make sure that you get good education, because it's not all created equal. There are different people out there that promote different things. And it's unfortunate that there is kind of the self-dealing interest with some of the people out there that are selling products that are kind of coloring the education they put out there to drive people just to their product that doesn't educate them on the other options out there. So that's pretty much all I'm going to say on that. Just understand, where the education is coming from and making sure that it's in line with your values and what your goals are. Because ultimately, remember, at the end of the day, you need to have accountability. You need to have realistic and attainable goals. And how do you get there? By having a good foundation of education. And if that education is all skewed towards one type of education that you got that's pointing you towards one type of product, that may or may not work out. I would say the adage of diversity is key in retirement certainly holds true. Again, ultimately, whatever type of strategy works best for you, someone like a registered investment advisor or a CPA or an attorney is the person to turn to for the ultimate, final questions getting answered on where you want to go with your retirement. So understand that there is different types of education out there. It comes from different sources, and those sources ultimately might have different motivators as to why they're putting it out there. That kind of brings us to the end of my presentation. I do appreciate everyone being here. If you have any questions regarding this or something kind of piqued your interest, schedule a consultation with us. Everything we do is always free. You don't have to pay for giving us a phone call and things like that. We're always happy to help clients and non-clients alike kind of get your roadmap started and get you on the right path to where you're trying to go. Again, here's all my contact information. Feel free to shoot me an email, a text. Give me a phone call. I will certainly happy to answer your questions during normal business hours, or if you shoot me an email, you might get lucky and find me after hours as well. So please feel free to contact me. Here to be a service to you. Thank you very much for attending today. I'll hang out for a few more minutes if we have people on here that want to type in some questions. So fire them away. But thank you, and that's all that we have for you today.